Price divided by earnings is what gives you the PE ratio. The purpose of the PE ratio is to see how expensive a company is compared to how much profits it's made over the past full year. When you're buying shares of stock, it's best to think of it as if you're buying a company, because really that's what shares of stock are. Shares represent an ownership interest in a company. How many shares outstanding a company has is the number of shares that the company's ownership has been divided up amongst. So if you buy 1% of these shares that a company has outstanding, then it would mean that you own 1% of that company. The PE ratio can either be price per share divided by earnings per share, or it can be the price for the entire company, which is also known as its market cap, divided by the total amount of net profits the company has made over the past full year. Most websites and most apps will show you the PE ratio that's using the per share information, but you would get just about the exact same result whether you're calculating the PE ratio on a per share basis or on the basis of the entire company. However, they won't always be the exact same, and this would happen if the company's share count has changed throughout the past year. Because companies can issue new shares and they can also buy back shares as well. And both of these actions will cause the shares outstanding amount to change. Now I talk about why they do it and how it works when companies buy back shares or issue new shares in other videos on this channel. So we're going to stick to talking about the PE ratio in this video right here. Now by the way, net income, net profits, and earnings are all different names for the same thing. It's the money that's left over after all the cost of goods, all expenses, and all taxes have been paid. This is the money that could be paid out to shareholders as a dividend or reinvested back into the company to grow even more. Alright, so a lower PE ratio means less expensive, and a higher PE ratio means more expensive. But as you'll see in a moment, there's a little bit more to it than just that. For example though, would you rather buy a company for a price that is 5 times the amount it's made in profits over the past full year, or buy a company for a price that is 30 times the amount it made in profits over the past full year? Well, 5 times earnings is definitely cheaper than paying 30 times earnings. So 5 times earnings is definitely sounding like a much more attractive price. Does that make sense? But the one major problem with the PE ratio is that it doesn't at all account for future growth in earnings. If company A, for example, is priced at 5 times earnings but not growing at all, and company B is priced at 30 times earnings and will grow its earnings by 20% per year, year after year, then company B might actually be a better investment than company A, even though it has the higher PE ratio. Because if we look forward 10 years, company A would still be earning the same amount of money, while company B would be earning significantly more profits and still growing. The best of both worlds is if you buy a company that is growing and trading at a nice low PE ratio. For example, Warren Buffett started buying Apple stock for Berkshire Hathaway in 2016. And at that time, it had a PE ratio as low as 10 and as high as 13. Since then, it's grown its annual earnings per share by roughly 18% per year, on top of paying out a bunch of their profits as a dividend as well. So this has definitely turned out to be a really great investment. A more advanced ratio, called the PEG ratio, was developed to factor in growth. Now the PEG ratio is the price to earnings ratio divided by the growth rate. So if a company was trading at a PE ratio of 10 and was growing its earnings by 18% per year, it would have a PEG ratio of 10 divided by 18 equals 0.55. If a company was trading at a PE ratio of 20 and growing its earnings by only 5% per year, then it would have a PEG ratio of 20 divided by 5 equals 4. Similarly to the PE ratio, with the PEG ratio, lower is better. And it's generally thought that if the PEG ratio is below 1, then you might be looking at a potential good investment. Apple in 2010 had earnings per share of 54 cents, and they grew that up to $2.31 of earnings per share in 2015. This would be an annualized growth rate of 33%. So when Warren Buffett started buying Apple stock in 2016, if he was buying when the PE ratio was 10, then it meant the PEG ratio at that time was 10 divided by 33 equals 0.30. Now that's amazing. And if you were to have copied Warren Buffett and bought Apple stock back in 2016 when he was, then for every dollar you invested, you would now have $6, including dividends. So if you invested $1,000, you'd now have $6,000. If you invested $10,000 back in 2016, you'd now have $60,000. Or if you had invested $100,000, then you'd now have $600,000 and so on. But this example actually points out a limitation of the PEG ratio. Because when Buffett was buying in 2016, the growth rate over the previous 5 years, as we just said, was 33% annually. But the growth rate in the following 5 years since then has been only 18% annually. So what this means is that just because the PEG ratio is nice and low, you still have to be very confident that the company will be able to continue to grow in the future as well. Now, if you want to keep expanding your stock investing knowledge right now, I've made another great video for you right over here to watch next. In this one, you're going to learn how to safely invest money in stocks. And it covers this for anyone that wants to buy individual stocks and also for those wanting to just buy low-cost index funds as well. And also a quick disclaimer, my content should not be considered as financial advice. That's all. So click here right now to keep learning, and I'll see you over there.